All right. Well, good afternoon, everyone, and welcome back. I hope you enjoyed the lounge. I know that it's fairly new. I know someone called it Date to Dream. Well, okay, but it was really for you get an opportunity to connect with the speakers. Just as a reminder to everyone, all the sessions are recorded. They're going to be available for you as well. If there's a speaker you want to connect with, and email them and or connect with them on LinkedIn, you can go to coursesummit.io, click on speakers, click on, you can search by them by name or by, specialty. Their bio will be there, headshot, LinkedIn link, and including their email address. We want to make it as easy as possible for you to engage with them. So this next panel, I know most of you out there are thinking, you know, the lawyers, the regulations, how do they make our dreams come true? They truly do. They truly do. Sarah and I, we were just getting started, and she goes, but I'm always telling them you're doing it wrong. And I go, that's how you make our dreams come true. By telling us that what we're doing is wrong and you're going to help us do it right. That's why it's so important. So today I have the pleasure of having a phenomenal panel, colleagues that I've worked with over the years and continue to work with as this ecosystem will evolve. So I'm going to give them an opportunity to introduce themselves so you can meet them. And then, of course, we will dive into the great discussion of these regulations under the Jobs Act. So, as they say, ladies first. Sarah.
Well, thank you, and thanks, Oscar, for setting this up. I'm Sarah Hanks. I'm CEO of CrowdCheck Inc. and managing partner of CrowdCheck Law. Between the two entities, we do a wide range of legal compliance, disclosure, and diligence for all of the Jobs Act exemptions. I'm happy to be here.
Perfect. Nat.
Was that me?
Yeah, that's you, sir.
Hi, Nate Dodson, Crowdfunding Lawyers. Very similarly, all we do is represent the securities, generally on the issuer side. Love working with entrepreneurs and really trying to help people reach their dreams and kind of a little bit different than saying you're doing it all wrong. I'd like to take the approach, what's your goal? And that's the main thrust. How do we get there? And I don't know what's going on with my screen. It looks a little fuzzy, so I'll work on that as well.
Yeah, no, you look good. All right, Marty.
Yeah, hi, Marty Tate. I am a securities lawyer that's been doing this for over 20 years. I represent issuers, platforms, service providers, broker dealers in the crowdfunding space, and have been doing that for since honestly since prior to the inception of the Jobs Act. Representative for a peer-to-peer lender back in 2008 when we didn't have regulations that were helpful and that didn't allow entrepreneurs to dream as well, I guess. But I've been working with Oscar and Sarah for a long time, and I'm happy to be here.
Perfect. Thank you. Andrew.
Hey everyone, I'm Andrew Bull. I'm the founding partner of Bull Blockchain Law. It's a law firm that specializes in blockchain technology. Pretty self-explanatory. We work with a lot of clients that are using these exemptions to launch digital assets, whether they're representing some element of ownership in a company or some other economic right. That's really, we're just handling kind of the legal side of that, as well as representing other clients in the technology space as well.
Perfect. Thank you. Great to have you. Mark.
Yeah, hi, this is Mark Roderick. I'm actually Sarah's boss over at CrowdCheck. No, I'm not. No, I'm not, actually.
I'm sorry, I'm having hot tea.
I am a lawyer with a firm called Lexnova Law, and I have been doing nothing but crowdfunding for about the last 8 years. Represent all kinds of issuers and all kinds of offerings and a whole bunch of the funding portals out there, although only the ones who are complying with the law, which is a minority, I should say. But yeah, so that's what I do, represent everyone involved in this wonderful emerging crowdfunding sector.
Well, perfect, Mark. Thank you. So today, the regulations is such an important piece of the Jobs Act, and so there's three regulations, and we're going to cover all three of them. And I'm going to ask each of you to kind of give just a high-level overview of each of the regulations, because I think it's important that people understand that it wasn't just one. There were actually three that obviously we're going to talk about today, and there's going to be one we're going to keep it with a twister. So I'm just going to go through each of you to kind of start it. So Andrew, I'll start with you. If you can go through Regulation D for us, so you can give a high-level overview of the regulation from a company perspective, the investor, and then therefore, and of course, the activity that goes with it from a company raising capital, please.
Absolutely. And I appreciate Oscar kind of giving me the softball question of the three regulations. So thank you for
that. I figured you would know this one really well.
Yeah, it's easy. So the commonly known as RegD, it's the most utilized exemption typically in this industry for sure. But the largest consideration is who is your investor pool. And under both the provisions, both 506B and 506C for RegD, you're really targeting accredited investors primarily. In 506B, you have a pocket of 35 non-accredited investors, but that carries some additional requirements as well to implement. But from a high-level perspective, if somebody's looking to offer, say, equity in their company or some type of debt offering or anything along those lines in regards to a dividend right or whatever the economic interest is, they're most likely going after accredited investors in the traditional sense. And RegD really offers kind of a streamlined process for simply filing an exemption and making sure you're in line with the anti-fraud provisions of the Securities Act. So at a high level, it's probably the most common offering that at least we see in the industry, and is very highly utilized and can be very efficient from a starting point to getting to market. And as a result, there are a lot of areas in the industry that utilize this exemption.
Well, that's perfect. Thank you. And it wasn't that easy, because we're going to come back to you. Seriously, right. I will, because even though you simplified it, so many people misunderstand how to use it correctly. And this is going to be a discussion between you and Sarah, because there's a RegD and a little S that comes right after it. So, all right. So let's go to the next regulation. This is a tough one. So I'm going to give it to Marty. Tell us about Regulation CF. It's a tough one, Marty. I know.
Well, it's Andrew and I were on a panel, I don't know, last week or so, and they thought they were giving me a softball question and just said, "Hey, so what's a security?" And honestly, I hadn't been asked that before, that directly. So this is a little easier. So regulation crowdfunding, part of the Jobs Act. It's I guess RegD is more common, the most common. RegCF continues to gain momentum. I think it was when people think of crowdfunding, this is kind of what they reference, even though all three exemptions can be used to do quote unquote crowdfunding. But RegCF allows issuers to raise up to $5 million from accredited and non-accredited investors. There are some parameters to that. The offering has to be done through a licensed intermediary, through a funding portal, a licensed funding portal, or through a broker dealer. There are limitations on how much each investor can how much non-accredited investors can invest, like I said, the benefit is that non-accredited investors can invest, and it really is a good way for it. There's not a lot of expense to it. It's fairly inexpensive, and allows issuers, companies, entrepreneurs, startups to go out and raise, especially if they're good at marketing and good at working their networks, to go out and raise capital from those networks.
All right, thank you. It was a tough regulation. I could tell you were really. I could see you're just running through it. It must be all those years you guys go to law school that they give you something so simple. Woo! It can't be that simple. All right, Regulation A. All right. So Regulation A, obviously, we all know where that came from. So we owe it to Sarah to bring that on, who helped coordinate that and rewrite what we now have, Regulation A+. Sarah.
All right. So I'm going to start by sort of putting all of the three regs in context, because all three of them are exemptions from registration with the SEC. Basic rule that we're dealing with here is if you sell securities, however Marty defines them, in the United States, that sale must be either registered with the SEC or made pursuant to an available exemption. And these three exemptions are the available exemptions that apply to crowdfunding. So Regulation A is probably, the big sister of all of them. And you'll notice that Oscar had mentioned Regulation A+. If you go looking in the SEC's rules and you go searching for Reg A+, you're not going to find it, because that's a nickname. Reg A+ got its name when original RegA, which has been kicking around since 1938, believe it or not, was upgraded because nobody was using it. And David Wild, who you heard from earlier, he was among the people who said, look, you've got this great exemption. You should make it easier for people to use it to raise money. So earlier RegA was limited to $5 million. And if you did a RegA, you had to go through state, not just get reviewed by the SEC, but also by the states. New Regulation A+, that lets you raise, since March, up to $75 million, assuming that you use Tier 2 of Regulation A. And you'll notice when I'm talking, I'm always going to ignore Tier 1 because it doesn't work for startups. If you are if you hold real estate assets and you're selling in a limited number of states, might work for you. It will not work for most startups. I tried it once; it was a nightmare. So Tier 1, the rules there are you can raise up to $20 million. You don't need audited financials according to the feds. You probably do according to the various states, and you have to be reviewed by the SEC and also every state into which you sell. So I'm setting that one aside. Tier 2 of Regulation A, raise up to $75 million. You file with the SEC, and they review all of the financials and all of your material contracts. They push back at all of the disclosure. It's a proper review process. But you do not have to go through any kind of state review. You just have to file state notices. You can sell to anybody, accredited or non-accredited. If you sell to non-accredited, you have to make sure that they have represented to you that they are not investing more than 10% of their income or their net worth. And you can rely on their statement. You don't have to individually look into it. The biggest piece of all of Reg A, of course, is getting everything ready to go through the SEC, because it's not like registration, but it's not just like, fill in the boxes or answer a questionnaire and then file it. It is, it's a substantive review process. And we've been through the process, I think, 126 times now. And qualified 126 of them. So I am a huge fan of Reg A. I think it is a very appropriate level of disclosure for early stage companies. And I would love it if the SEC would use Reg A to be the basis for full registration for early stage companies. So they don't have to file all of the stuff about the blood diamonds and have to have audit committees. It's perfectly pitched for early stage companies. Back to you, Oscar.
Wow, that was good. That's a great way to, it is, you're right. I mean, look, I'm a Canadian and I love the Jobs Act. You all know that. I am the biggest champion. I carry a flag telling everybody how wonderful. Until you live in other jurisdictions, you really do not appreciate it. And that's why every single time I speak to an entrepreneur, just be thankful you have three choices. Be thankful you have three national, let me put it this way, national three choices, not just regional, three national wonderful exemptions So we're going to get into that dialogue, and I'm going to start with you, Mark, because I know you and I have been on a few panels together, and I remember way back we talked about, you know, the importance of the retail investor and how this becomes a win-win. So let's talk about that right now with the Jobs Act, and in particular with the 3 regulations that we talked about, how it becomes a win-win both for the company and for the investor. Because I remember you saying that really eloquently in one of our panels. You may recall it was only a few months ago, and I got that in. You had a terminology for it, so I wonder if you could fill us in with that.
Boy, I wish you had recorded that and could play it back, because I'm unlikely to match eloquence again. But actually, I mean, one thing that and I think all these other panelists share is we are evangelical about the crowdfunding space. This is actually part of answering your question rather than just a speech. But I think, I mean, all of us, although, I mean, I know I'm by far the youngest of this group, but we've been doing this long enough to have seen how difficult it is for entrepreneurs to raise capital under the old-fashioned pre-Jobs Act systems. And simultaneously, I mean, outside our role as lawyers, I think all of us are aware, and you are aware, Oscar, and your audience is aware of the enormous inequalities of income and wealth that we have in this country and indeed around the world, where, you know, the top 10% just become extremely wealthy, actually beyond even belief. And more of everyone else gets left behind. And so it's my view that crowdfunding can address both things, and indeed has to address both things. We can't have a crowdfunding system that is only good for the issuers of securities, meaning only good for the entrepreneurs, can't exist by itself. It can only exist if it's also good for investors, for ordinary Americans. At a conference in Chicago that I've been to several times, there's a guy who always says, ordinary, hardworking Americans. But anyway, for ordinary retail investors to do well, right? We in the industry, I think, too often look through only one end of the telescope, which is the issuer and portal end of the telescope. But you have to look through the other end of the telescope as well. And for the industry to prosper, as I believe it will, the industry has to look equally attractive from the investor end. And so ideally, what is going to happen here, if some of these funding portals will get their act in order, either of their own initiative or being policed by government regulators, is a system where entrepreneurs for the first time have access to capital no matter where they live, you know, whether they live in Silicon Valley or North Dakota, no matter the color of their skin, no matter what their parents do for a living. And at the same time, ordinary Americans will have the opportunity for the first time ever also to invest in very, very high quality, I'll use the term institutional quality, investments that can begin to chip away at some of the income and wealth inequality. But the point is, it needs to work for both parties. If we develop a system which you can unfortunately sometimes see the beginning in on some of the large funding portals, where it's sort of let the buyer beware, that's not going to work over the long term. It may work over the short term, but not over the long term. It has to be everyone getting a good deal. Entrepreneurs access to capital, investors access to good deals, sometimes great deals. And if that happens, as I think I and all the other panelists, and you hope and expect it will, this is really going to be something big.
I agree. I agree. You know, it's interesting. And I want to touch on this, and it wasn't even intended, but you brought it up, and we're going to hear more of this from Sherwood Neese. He's going to share the deep insights, who's been tracking our ecosystem since day one. What is really, really astonishing, which everyone should really applaud themselves, is that the Jobs Act is working. I want you all to know that. Minorities, are rising, and the crowd is embracing, so that that equality is starting to happen, which is fantastic. And not only that, the age of the entrepreneur is shifting. It's not just the millennials, it's the 40 plus that are getting the larger rounds as well. So all that deep insight is showing that the work that's gone into this is great, that the regulations need work. Don't get me wrong, nothing's perfect. We all know that. All of us in this room, we've all gone through, oh my goodness, we need to make this thing work somehow. We do, because we know that in the long haul, it's going to make it better. So I applaud you all for that commitment. And you are right. We're all evangelists at this stage. Somebody always says, well, what stage is this sector in? You know, Andrew Korn says we're in first base. Some people say we're only in a percentage. All I can tell everyone, I'm 12 years in, and like many people, I'm just as excited as I was 12 years ago. And I still believe that I got another 10, 15 years. And I know that it's coming faster now, but don't know yet where it is, because we're still trying to solve a lot of the unknowns that are starting to arise, which is a good thing. It's not a bad thing. It's a good thing. So I'm going to turn the conversation a little bit now, Nathaniel, because, Nate, my apologies. The combination of using regulation is one that comes up a lot by entrepreneurs. This ability, I remember once somebody said, I want to do a RegCF and a RegD and a RegA simultaneously. Okay, I know you're all laughing, but so tell us that, the combinations you think would work and why, and which ones you think, just in your humble opinion, of course, which ones would not work.
Well, sounds good. And when somebody says, I want to do the RegD, RegCF, RegA, I want the world, all I really hear is, well, they're trying to raise capital for their business. So it comes down to what's the most effective and easiest way for them to actually reach those goals. And looking at the three regulations, I'm a massive fan of Regulation A, but it does cost a lot more. There's a lot more work and time behind it. So it's a fantastic vehicle, but not necessarily for that first round Series A capital. Although it is great once the entrepreneur has their legs under them and are looking to take their business to that next level. Now, Regulation CF, again, it's great for the startups, but there's a lot of work, audited financials. Generally, if you're trying to hit that $5 million limit, you are working through the third-party crowdfunding portals. There's a lot more that is going on that side. And then to take kind of that, what's the easiest? RegD is absolutely the most used exemption because it's the easiest one to get it up, going, and started. So definitely when you talk to the entrepreneurs, they want to see, hey, how can I get my money? How can I get my business going the fastest and easiest way? At least in my humble opinion, it always comes down to kind of a RegD kickstart while trying to figure out next steps, the Series B or as it continues to grow. Then you may consider a RegA or Regulation CF. And to bring up how the different regulatory regimes work together, there's always a concern. They call it integration. And integration means if you have multiple offerings happening at the exact same time or close in time together, is a regulator, SEC, states, are they going to look at everything that you're doing during that time period mash it all together and figure out, hey, did you violate any of the securities rules? Previous to 2021, and really has changed to a helpful extent, it used to be you had to pay attention to really the structure of the offering, what it's doing, goals, etc. if there's two separate offerings within a 6-month time period. And that's been changed now. At this point, they call it a safe harbor. And as long as one offering is closed a minimum of 30 days before the next offering, then the offerings don't get integrated together. And really, you can run them not simultaneously, but it is in successive order. And with that, you could really do whatever makes the most sense between the Series A, Series B, etc. Also, we would have clients that, as an example, with the 506B, they have greater expectations of the scope of the reach of their network, hit their head and just, we can't find any more money. We've got to go some other directions. There are some ways to just kind of go under the Regulation CF, the 506C, or even start the Regulation A process. However, no matter what, it's generally easiest to have a 30-day close the offering, reevaluate what's going on, to reopen and start moving forward. But there's always those considerations going on as you're going from round to round.
Yeah, I agree. You know, the one thing that prior to COVID-19, I think that was, I think you're right. Everybody would start with RegD because it's such, you said it, it's the easiest one. People go, I don't need audited financial statements. I don't need this. I don't need that. But I often wonder, like when it comes to the total cost and the total component of onboarding, prior to COVID-19, I would get it. You can meet the investor face to face. They would be not as reluctant to give you all that personal data that the company would need in order to do the verification or send them to some verification part. But now I'm obviously seeing it a little bit differently. The question we're asking companies, I don't know if you guys are doing, my apologies, if all of you are asking this question, which is, do you currently have a pool of accredited investors who are going to participate in this round? If the answer is yes, then then let's proceed with a RegD. I saw this presentation like this by Joel Steinmetz from Rialto. It was a really brilliant question to ask the company to determine whether a RegCF was the right to go right now or a RegD. And by not having any, the pressure is both on the company and the BD to find investors. And in this climate, the better choice was to go to a RegCF. They can still go after the accredited, as Marty alluded to. You can attract both accredited and non-accredited, and you increased your larger pool. Yes, there's an initial cost, but that cost is so minimal compared to the other route. So we're solving it is, again, I keep going back to the same thing. Having great regulations to make that happen is the key. You have that flexibility. I'm so used to, no, you can't, and this is the only way to go, and that's it. So I've always been caught up in that. So Marty, I just want to come back to you with one particular question, because I know that you're working with a number of clients. Where are you seeing, from back to what Nate indicated, from the 3 regulations, where do you see the makeup happening with your practice? Is it RegCF, RegA? Is it RegD, RegCF? Just give us a little bit of insight of that, and as I go to the other members as well.
Yeah, and I think Nate asked, really approach that correctly. Every time somebody comes to me and says we want to do this offering, do an offering, and a lot of times we'll get that, hey, I want to do a CF, a RegD, and a RegA. I think that the appropriate question is, how much do you want to raise, and who do you plan on raising it from? And I think that there are, we honestly we see people using all 3, and a lot of it, like I said, depends on how they plan on marketing, who they plan on raising it from. And I do a lot of fund formation work, and a lot of times these fund managers are experienced. They have networks, and they don't have any use for RegCF or RegA. They have their networks. They're going to go out and use a 506, a RegD offering, and that might be a 506. Typically, it's a 506B, but they might say, hey, we also have a website, and we're going to put it up there, and so we'll do it as a 506C. For entrepreneurs that are just starting out, I think RegCF provides a really good solution for them and really good access. And one of the things that we're seeing is that platforms, as more and more platforms become available, as broker dealers enter the space, you're able to kind of direct them to the right spot that will help them raise that capital. And then some people just say, hey, $5 million is great, but we need more money. We have a good marketing, we have a good marketing team, a good marketing plan, and we're going to go out. And so RegA becomes the answer, or they just feel like that's going to get them to where they want to go eventually. And a lot of times, and other people can chime in on this, it's, we'll kind of start with both. We'll say, great, let's go out, let's go through the process. You ultimately are going to do a RegA, but let's do a RegCF initially. Let's get some of that. Let's get some money in the door to help you fund that RegA, or to fund the marketing efforts associated with that. So again, it really depends on who they are and where they want to go. And one of the things, like I said earlier, is a RegCF is not super expensive, and it allows them to, although you can test the waters in a RegA, it does allow them to go out and test the waters in that way, and raise some capital that and figure out how much interest they have. A lot of my clients have done RegCFs, and they said, hey, that worked out really well. Let's go do a RegA, because we feel like we have a lot of momentum. So
that's good. So Andrew, I mean, you're dealing in digital security. So of all the professionals here on the legal side, your firm has really specialized in a very kind of, I'm not going to call it a niche, because it shouldn't be that, and I'm not, because I think we need to start dealing with the fact that if we're going to have thousands and thousands, hundreds and thousands of investors, the better way to do it is on blockchain. We clearly know that value, but you've been right at the forefront with that, leading on. So tell us about the use of the regulations you're moving to. I know you and I come to light with Regulation A+, which is fantastic, but give us your journey that you're working with clients in these 3 regulations with digital securities.
For sure. Yeah, absolutely. And Oscar and I have had this conversation over a longer period of time of kind of the misnomer around digital securities and tokenization, and a lot of different terms that are kind of thrown around that aren't accurately describing what it is that someone's trying to accomplish. So at the end of the day, they're really trying to digitize the economic right that would be offered in the traditional context. And so these exemptions equally apply in the digital asset and security space, just as they would in the traditional asset space. And up until 2017, we actually didn't even know that the SEC was going to treat different types of tokens as securities. And they finally weighed in on the subject and gave us some clarity around that, which definitely helped out a lot, because that pushed a lot of US-based companies and foreign-based companies looking to offer in the United States towards these more traditional regulations. And the compliance side of the industry that I've been in for a while upticked drastically. So it's been very, very beneficial that we got that clarity, even though it came through an administrative ruling against the company. So high level perspective is, and I like to kind of clarify this point as well, is that utilizing, and Oscar alluded to this, utilizing blockchain technology and really digitizing assets isn't changing the regulatory landscape by any stretch of the imagination. It's just utilizing a different technology, a more efficient technology, to be able to transfer those assets and also verify who owns those assets. So realistically, it's And I think that some people in the industry kind of get confused around the lack of consideration over the exemptions, because it really is an important step in this process to get to the point of being able to offer a digital security. So thinking about the exemptions more specifically, back in 2017, when we got this clarity, RegD started really coming into the fray in that context. But at the same time, because of some of the underlying principles and theories behind blockchain technology, RegCF and RegA, Tier 2 specifically, really lend support to this general notion that I think David was describing in depth earlier about trying to open up to the retail investor in a kind of a regulated way. Because for those of you who know the cryptocurrency industry, there is a significant amount of non-regulatory actions going on by companies in that space. And unfortunately, that leads to potential issues and run-ins with governmental agencies like the SEC. So high level, we're now seeing an uptick as well in the RegCF context as these FINRA-approved third-party portals now start to integrate the technology into their platform, which really allows somebody that would traditionally just go through that platform anyways to do a RegCF to be able to digitize whatever the economic right is that they're offering. And you then take that, and I wanted to go back to, I think it was Marty's point about the RegCF as a precursor to the RegA. I think that's such a good point. I wanted to just kind of overemphasize that, because especially what we're seeing in the digital security space, there's an educational hurdle for prospective investors more so than in the traditional security space, because they're like, oh, do I have my own private keys? Like, do I need to create a crypto wallet? There's all these questions that are not really prevalent in the traditional side. And RegCF in that context also allows for that preliminary kind of process to go through of educating prospective retail investors in that context, which leads into then going to RegA. I filed a RegA application in 2017 for a blockchain company that was tokenizing their assets, and it was I think we got like 250 questions back from the SEC wanting clarity. And they just pivoted and went to RegD. And luckily, that's not the reality of today. And we've seen a large transformation, and the FinHub has been super helpful with the SEC. But yeah, I think that just kind of harping on that notion that these exemptions that allow for this expansion of the investor pool really align with the way that blockchain technology is utilized in the traditional sense. And as a result, we're seeing a massive uptick in the usage of those exemptions.
Yeah, I'm glad you teed it off that way, that it's not a separate thing. It's just going to make things more efficiently. Today, the closing of the day is about secondary market trading. So it all starts, the lawyers help you create your offering and make sure it's fully compliant. So if you want your dream to come true, you have to start with the word, it has to be fully compliant. Because just because you got the money in the bank doesn't mean you won't have to return it. And then you'll have to wear a nice, pretty little orange outfit. So now we need to start really thinking about this. Yes, we now have the ability to trade. So you need to put that in your mindset. So all of that is the new considerations as you're using these regulations. And I'm going to bring Mark in because there is something really interesting about these regulations that wasn't brought up, and I'm going to put it in here, which is, we now know that secondary market is available. Now we have these wonderful regulations, and we obviously know RegA is the ideal, but we're also using RegCF as a stepping stone. But sometimes we've seen this, and I know that Mark has spoken with Marty, and all three of us, we've had an interesting opinion on this, where sometimes what's happening here, a new vehicle has been introduced. So I'm going to give you an opportunity, Mark, to talk about the SPV notion. And I know you've shared your thoughts on with me previously with Marty. Do we need it? And where would be the cause when you would use it, knowing now that we got secondary market trading? Please.
Well, yes, I am an SPV skeptic. The SPV is a solution to a problem that doesn't exist, but it's a real problem. It's a psychological problem. Many issuers, I guess particularly those on the West Coast who have, kind of surrounded by Silicon Valley folks, have come to, or believe, or used to believe at least, that if you do crowdfunding, it, to use a technical term, screws up your cap table. And so we can't do crowdfunding, because we want to raise real capital in the future from the VC community. And so, we don't want to do anything to jeopardize that. Now, that's just not true. You don't screw up your cap table through crowdfunding. You screw up your cap table by issuing the wrong kinds of securities. So as an example, if you issue securities to your 10 closest friends and give those people all kinds of control rights, preemptive rights, the right to elect directors, blah, 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 you have probably screwed up your cap table. Whereas if you give 1,000 RegCF investors a non-voting stock, you have not screwed up your cap table. It's not the number and it's not the mechanism for selling the securities. It's the terms of the securities. Nevertheless, there has been this, this fiction that crowdfunding screws up your cap table. And so how do we fix that? Well, we create an SPV, a special purpose vehicle, where all the crowdfunding investors, will congregate and they'll own shares of the SPV, and the issuer will just issue shares to one entity, and that's the SPV. So the issuer has one entry on its cap table rather than 1,000, and now we've solved the problem. So the SEC, in its almost unbelievable desire to help crowdfunding, created this SPV. It became effective in March, along with all these other great changes to RegCF. And so companies can now, as of today, use SPVs rather than issuing shares directly. So on the one hand, it's great, because we can now, if we do have an issuer that thinks it's going to screw up its cap table, we can use an SPV instead. However, there are some issues, and one of the issues, the technical legal issue, is the way the SEC wrote this SPV regulation as part of the Investment Company Act. It says if you invest in the SPV, you have to have the same rights that you would have if you invested in the primary issuer. And as an astute commenter named Sarah Hanks pointed out to the SEC, well, for example, what if the issuer is a corporation and the SPV is an LLC, or what if the issuer is a Mississippi LLC and the SPV is a Delaware LLC? State laws differ. And the SEC kind of blew off Sarah's comment in a not quite intellectually honest way. And I personally have had conversations with the SEC about it, and I sort of asked them, well, did you mean to blow it off? Are you really saying that anything goes and you're just going to look the other way? And they say, no, we didn't mean to blow it off. What we really mean is that all the material rights have to be the same. But it begs the question, if the difference between an LLC on the one hand and a corporation on the other, there are definitely differences in material rights. So without going into any more detail, there's a nagging question as to whether SPVs, as they are currently being used by the large funding portals, are actually disqualifying all of these offerings. So that's a thing to be concerned about. And then, of course, SPVs actually, don't really solve any problems, and they just add one more layer. A lot of people, when they think about SPVs, think, for example, well, boy, I'd rather only send out one K1 if I'm an LLC than 1,000 K1s. But the SEC does, or the SPV doesn't solve that issue. Yes, you're going to issue one K1 to the SPV, but you're going to issue, the SPV's then going to issue 1,000 K1s. So you're actually going to issue 1,001 K1s. So with all that said, that's why I'm not an SPV fan, both for practical reasons, it just adds another layer of complexity, and for this very significant legal reason that, by using an SPV, you might be undermining the integrity of the RegCF offering in the first place. However, there is one reason to use SPVs. I personally don't think it's a compelling reason, but it's a reason. And here's the reason. As all of you know, there's this rule under the securities laws that if you have too many shareholders, you have to start filing publicly as if you were a fully public company. So that's the rule. There's an exception to the rule. If you do a RegCF offering, the shareholders who buy shares in that offering don't count toward those thresholds. So that's a good rule. But of course, this is the government, so there's an exception to the exception. If you get too big, if you have too many assets on your balance sheet, then you're back to the first rule, and you have to do public reporting. For reasons that I do not understand, but it doesn't matter, the SEC says that if you issue shares through an SPV, then you are not subject to that exception to the exception. So you can have as many assets as you want, and all those SPV security holders out there don't count toward the threshold. Well, that's something. Now, the likelihood, I think, that most or almost any RegCF companies are going to end up exceeding the threshold, before they would start public filing anyway or would have an exit, I think it's going to be extremely rare. But it is a reason. So I think I've probably now confused the whole thing. Not a fan of SPVs for legal and practical reasons, but there is this one thing, the Section 12G of the Exchange Act thing, that could cause people to think differently.
I appreciate that. I share your concerns. My concerns are a little bit more, they're not more from the legal side, more from the practical side from an investor. I'm always trying to put that, let's all not forget this, that we're still dealing with, investors that are not so much learning about investing, that's not right, or anything like that. It's just that they're not familiar with all these terminology, safe, crowd safes, convertible debentures and all these things, which is very common when you're dealing with accredited investors, or even then, you still need to provide level of education. But if you have to do it to 30, 50,000 people, it's very difficult. But the biggest challenge I see is that if a company has already raised capital and already has a crowd, and it has an ambition, I think Marty said it, Andrew said it, Sarah, that to raise additional capital, now you have this arm over here of investors, let's say 1,000 of them, because you brought in the capital through the SPV. Now you do a RegA. These people here are not going to be able to participate the same way the ones that are coming in RegA. So I'm looking at it more from just how does it look from the optics point of view, from an investor's, how they feel about that. I'm mid-managed over here with that. I thought I invested in the company directly. And that's another thing. The SEC should be paying a little bit more close attention how that is disclosed, but that we'll get to that hurdle. So, but it is an interesting component of the regulation CF that I wanted to bring up, and I'm going to bring another one now, and I'm going to let you all chime in. But first, we're going to start with Sarah. So, I don't know how many of you are familiar with this, and I know the audience here. I got asked this question a few times, and I want to make sure that I address it, and we definitely have the time, so I want to take advantage of it. And we're going to talk about Regulation D with S. And so, but I'm going to give you all heads up, okay? So before you say anything, Regulation S is Regulation Sarah Hanks. Okay, good. So now you know. So just remember that. So let's talk about Regulation S. So I'm going to go to you, Sarah. Give us an overview, and then you and I have spoken very candid about what people need to watch out for. And then I'd be interested to hear, please jump in, ask questions from Marty, Nate, Andrew. Obviously, you've all used this part of it. How does that fit in with what with the insight that Sarah's going to bring out? Sarah.
Well, to forestall part of the question, it really doesn't work very well. It sits incredibly uneasily with any of the exemptions that we use for crowdfunding, and the reason is that Regulation D, 506C, Regulation A, Regulation CF all permit general solicitation. Regulation S does not. Now, what Regulation S is it's an exclusion of the securities of the application of registration requirements of the Securities Act. It's not technically an exemption. It is an exclusion that says when you are selling securities outside the United States registration requirements don't apply. And you might think, well, yeah, duh, obviously. But the reason that Reg S had to exist, and it's based on Release 4708 before it, and wrote no action letters based on that regulation. The reason it had to exist is that Section 5 of the Securities Act says if you sell securities to the public, doesn't say in the United States. And so you needed that clarification. US law applies when you're selling in the US, when there is a jurisdictional link. And so what Reg S is saying, if you're selling Eurobonds, which is what it was designed for, selling Eurobonds in Europe pursuant to European regulations, not required to register with the SEC. And so, it was used in very large offerings, multi-billion-dollar offerings, Eurobond offerings for years. And then, of course, we come around to crowdfunding and everybody's, yeah, I'm doing ICOs and I'm going to sell them in Bermuda and I'm using Regulation S. And I'm going, but you've got the offering here on your website and I, in the US, can see it. And so you're offering to me. So that it doesn't actually work, because Regulation S is supposed to be completely outside the United States, no directed selling efforts in the US. And directed selling efforts isn't exactly the same as general solicitation, but it's almost a complete overlap. If you are generally soliciting, you've almost certainly done some directed selling efforts, and directed selling efforts can be even broader. And you are not allowed to do directed selling efforts under Reg S, which means if you're going to do Reg S alongside a Reg D, you have got to geofence the Reg S. You put all of the material there. It is not accessible in the United States. US persons can't get to it. And you're offering materials in the US should not say anything at all really about Regulation S. The most we ever say is we're simultaneously doing offerings outside the United States. Now, people know what that means, but that's the maximum you should be doing. It really does have to be completely offshore, and not have people say, "Oh, yeah, I'm definitely offshore. I'm seeing the offering on my computer here. I'm in Cayman Islands, or I'm in Bermuda." Just don't permit that to happen. And so, even though it's my baby, I love it. It took a few years out of my life. It is not something you really want to be doing together with Regulation D.
Oh, I was on mute. Here I was talking. That's a great insight. Sarah, I get into conversations with people that think, I just want to get your thoughts on this as well. And please, anybody else that wants to tie into this, but often people get the assumption that because you follow Reg S, now I can go outside of the United States and then I can target non-accredited investors because that's what Reg S allows. Can you bring some clarity into that?
Yeah, that's it's a good thing you raised that, because that's another really common mistake. Regulation S tells you how to avoid the requirements of US securities laws by making yourself not subject to them. It does not at all affect what's happening over in France, Bermuda, Barbados, wherever. In all securities offerings, in all developed countries, there are usually some form of rules about how you can make securities offerings and who can make those offerings. So the equivalent of, registration under the 33 Act and registration of broker dealers or similar people, people making financial promotions. Regulation S doesn't help you with any of that. You've got to go to French law. If you're selling in France to non-accredited, you've got to go to French law and say, can I offer this sort of thing in France? And what do I need to register or qualify or get approved? And am I allowed to do it? Or do I need to go through some regulated person? All Regulation S ever does is say the US registration provisions don't apply to this transaction. And by the way, just the registration provisions. Anti-fraud always applies. If there is any nexus at all, the SEC is going to get you for saying misleading things.
Well, I don't know about the rest of you, but it's a good eye opener for everyone. It's not the past that everybody. I was on a previous call just to this with a company out of Florida, and I live in Canada, so I already know if I can't sell to non-accredited, neither can you. And so that's why we operate the way we do. So here I'm going to go around. I want to get your predictions, because we're closing off 2021. So think back, each of you, just take a couple minutes. Think back of the work that you've been doing. Where do you think it's going to be now for the audience that's coming in? Of course, you're going to listen to, but based on what the work that you're working on right now, where do you see it? Is it going to be a mix of RegCF, RegA, or are you going to still be doing the one over more than the other? I'm really curious to hear that. Obviously, this is just your insights into to the regulations, because I'm also going to show you right now on stage. This is what the audience is saying. So the audience is right now that participated, 44% of them are saying that they want to do a RegCF. 33% are saying that RegA. So right now it's almost like 75% of the whoa, wait a minute, the votes are coming in, but as you can see. So based on that, I'm gonna seriously, don't you guys love this new tool? We never had this before. We can ask a question and then
can we see the answer then?
Well, it's right there. You guys can't see it? It's on the screen. Oh, I'm sorry.
I see the question.
Oh, no. Yeah. So it says that RegCF right now is 41%, RegA is 41%, RegD is 16%. So based on that, Andrew Ball, I'll go to you first. Where do you? Yeah, tell me about 2021 and 2022.
Yeah, absolutely. I really think that, going back to your point about the impact of the pandemic and face-to-face conversations and how crucial those were in the traditional sense, I see RegA and RegCF really kind of skyrocketing in terms of adoption, maybe not skyrocketing, but increasing in adoption. And also because of the recent increase in the amount that people can raise, I think that's also another massive contributing factor that we're going to see a pretty large uptick there. And as more and more people kind of see this movement going on, especially in US society, in terms of access to investments and so on and so forth, those are going to be more interesting from the perspective of people looking on which one to choose. I'll leave it at that.
Perfect. Thank you. All right. So Nate.
In this case, very similarly to Andrew, I do think that RegCF and especially RegA are exponentially going to catapult over the next year, if not more. I think a big driver is actually going to end up being the tax laws. With everything that people are talking about in Congress, I know one of the big concerns with the economic disparity is the top 1%, the accredited investors, or top 10%, have access to investments that the regular people don't. And there's been the story earlier in the year that Peter Thiel's Roth IRA is worth $4 billion. And I've heard the rumors and the arguments and the discussions about, well, why don't we just not have qualified accounts, the IRAs, be able to invest into the private deals? And I think eventually they'll probably do something along those lines, but they're going to draw a line because it's really to allow everybody to participate and everybody to benefit, which RegCF and RegA Plus absolutely do. And so I think if they do ever come down with those laws, I think they're going to carve out the RegD options, but still allow the qualified accounts, the IRAs, to invest into RegCF and RegA, and at least kind of going from past experience and working with issuers that some of them have large amounts of IRA investors. If that's their only avenue, that's where they're going.
Perfect. And it actually, that coincides with where people that are attending these, where they're thinking, their mindset. And Marty, you've been sitting there quietly, my friend. I was wondering if you were going to step into the Reg S discussion, but please give us your insights where you're heading for 2022.
No, I don't want to step on Sarah at all. I'm going to let her go on that, but I did want to poke Mark a little bit on his SPV, of the passion he has about SPVs, but we had another panel discussion about that. One of the things that I'm excited about is just the evolution of both of these offerings, and especially with the increased amount. I think that a lot of offerings before that we would kind of say, well, I think your only option is trying to do either a RegD or a RegA offering. We're now saying, well, I think it makes sense let's do a RegCF. I mean, with the 5 million limit. And on the RegA side, we're seeing some really kind of fun and creative RegA off people doing things that are, out of the box using RegA, which I think is fun. You're seeing stuff on the digital security side. We're seeing stuff on, one client where we're doing like a rewards program, and we're doing that all through a RegA. So I'm just excited to see how the use and creativity will continue to expand.
Perfect. So that's it is important to note that, of course, all of you, and I'm going to get to Mark here, is that you're seeing the power. And it is interesting how it's shifting the discussion point from, we want you to have the best success, and the best success is now rethinking that strategy of the exemption, not to worry about what it is. I think it was, Sarah started it. All 3 exemptions, including the accredited investor, is crowdfunding. General solicitation, let's get it through everybody's mind so you don't get hung up. It is crowdfunding. And someone even wrote an article that all venture capital money is crowdfunded. And that's what they do. They crowdfund. So Mark, come back to you. I hear your comments for 2022 on the regulation side. I know you've been there from the beginning, so love to hear your comments.
Yeah, I know exactly what's going to happen in 2022. Now, as I tell people every single day, so what we are witnessing is a real shift, a seismic shift in how private American companies raise capital. Up until March of 2021, RegD, the old-fashioned private placement, I think a small slice of that in terms of dollar value in 506C, what we call crowdfunding. Most of it just private placement after private placement among accredited investors, using private money and private sponsors. That is how capital has been raised by private companies for, certainly since 1982 when RegD was issued. RegCF is becoming and in 2022 will continue to become the place where American companies raise capital. Every day, I'm sure all my colleagues on this panel get calls from prospective issuers. You know, this is what I want to do. How should I do it? And in the past, it's been more complicated. You know, we've had RegCF now for 5 years, but it was tiny and almost useless for most of that time. So you talk about, you know, 506C, yes, you can advertise, it's great, but you can't have non-accredited investors, and 506B and 35, and RegA is too expensive. But increasingly, I find myself coming to the conclusion as I'm having the conversation and then communicating to the issuer, it's RegCF. What's the downside? What is the downside of RegCF these days? You know, most companies that go out to raise capital are raising less than 5 million, and you can always raise more in a side-by-side offering, or quite easily from non-US investors using Reg S, Sarah. You know, and you can include non-accredited investors, checks another box, and accredited investors can invest as much as they like, checks the last box. So there's no downsides, or very, very few downsides to RegCF. So I see the entire market of private capital moving to RegCF. I don't see any reason not to use it, you know, unless, of course, if you've already got your investors lined up and you're just, you know, you've got a handful of accredited investors and you just need someone to prepare paperwork. That's a different thing because you don't want to pay the funding portal its commission. But you know, lots of times that's not the case, and therefore I think RegCF will increasingly become the place.
Thank you. And Sarah, you're right at the heart of this. You've been there. We're knocking off, I won't say decade plus 2. There you go. You're on.
Yeah, it is almost 10 years since I started tracking all of this. The one thing I would say with respect to Mark's prediction on RegCF is there are some companies, Canadians, for example, investment companies who are relying on an exemption from the Investment Company Act who can't use RegCF, so they are automatically pushed into RegA. But the you know, on the looking forward basis, I mean, what I've seen in the last maybe 6 months, and I think this is going to be a big part of our future, is we're in a period of consolidations and mergers and buybacks. I have done more in terms of mergers and trying to apply the roadblocks that are imposed by Rule 145, which says basically if there is a vote, there is an investment decision, therefore you've got to comply with the offering rules. With respect to acquisitions, as many of these early stage companies are merging, also seen some buybacks. Also, I have seen a bunch of rescission offers, and I think we're going to see more of them because, like I said, to take us right back to the beginning, I spent a lot of time going, y'all are doing it wrong. You got to fix this, otherwise this industry is going to die. So rather than being the you know, dare to dream, I'm like, I am trying to avoid your nightmares for you, and that's a lot of what we're doing.
I love that. Actually, that's a great, hey, that's how, you know, there's nothing worse for an entrepreneur. If you all know what it's like at night, you wonder if it's working, if it's not working. And one thing that I do want to mention, Mark brought it up, for Regulation CF, which you're all going to hear this afternoon, there is another option. The funding portal is not the only option anymore, which is really a testament to this work that all of you have done today. So Sarah, Nate, Marty, Mark, and I know Andrew Bull had to step away. Thank you so much for a great session. I know that we're going to need to continue to keep doing this journey of educating entrepreneurs. And I almost feel like that, we disregarded RegS for a long time. We thought that everybody got it. I think it's time that we need to rekindle that, bring it out to make sure that people, if you're going to use it properly. That's it. Just use it properly, because doing the other way is very, very painful, more costlier than you could ever imagine. Lawyers are not here to make your dreams fizzle away. They're actually trying to make it so they become a reality. And the reality is this: being able to attract investors, to be able to do it compliantly so it goes in your bank account so you can grow your business. That's the reality. The reality isn't where you do whatever you want, bring the money in, and then you got to do with the SEC, because that is not a reality, because you have to do penalties, bring the money back. That's not where any of us want to see you. So thank you so much, everyone. Looking forward to 2022. Just as a little heads up, January 26th is the next event, which is As You Dare to Dream. Now we need to get into the work, the goals. What do you need to do to get it done? Thank you, and we'll see everyone in the next panel. Thank you.
Thank you all.